Good afternoon, everyone. Gabe Velazquez here with you on a Tuesday. This is the 11th of October. Welcome, everybody. Hope everybody is having a good trading week so far. It's been very choppy. In fact, again, unless you've been living under a rock, we know that the big number. How you doing? English in Texas. I'm glad to see you. Glad you're back. So again, let's just recap. Unless you've been living under a rock, we know that the big number today or this week that will impact the market. And I think that's why we're kind of in a holding pattern. Is going to be the CPI number on Thursday. We also have Fed minutes tomorrow. We have a big grain report, so there's tons of there are going to be tons of volatility coming in. For the moment, though, since we had that big sell-off on Friday, I was with you guys on Friday with the non-farm payrolls and so forth. That obviously impacted the market, but all in all, the S&P has been in about a 60-point range, still trying to hold on to the lows here. The lows clearly the I guess we'll call them the cycle lows, right? Roughly around that 569 area. We kind of just keep bouncing around there, and all told, I don't think we're going to get any kind of resolution until Thursday. And again, the obvious call would be that the market goes down, but we know that again, anything related to trading, when it's very obvious. So just to recap, I'm not gonna really dwell on this too much because everybody kind of knows what's going to happen. Not actually knows what's going to happen. Let's put it this way: any kind of downward trajectory in the projected CPI number is probably, there's a lot of pent up money waiting to get into the market, so that should spur a big rally if we get any kind of downtick from the previous month, month over month, year over year, that kind of thing. However, just like with the non-farm payrolls on Friday, if we get either a flat or an uptick in that CPI number, then no question, bonds will tank just like they did Friday, and that will drag down stocks. And so until obviously we get that number, looks like we're going to be in a holding pattern. Now, we've had, again, just clearly everybody's still kind of on pins and needles. We had a Bank of England come out, interestingly, English in Texas. There's a bunch of stuff. I don't know, Englishmen in Texas, are you in contact? I'm sure you have relatives over there. About an hour and change, if you were looking at your S&P chart, we had that big kind of sell-off. Well, that came from the Bank of England, essentially advising all of the pension funds in England and the UK to rebalance because their bond buying gilts is going to. So you're not in Texas anymore. You're not in Kansas anymore. Okay. Yeah, I seem to have an issue here with okay. Okay. Yeah. Yeah, I think you do, right? Now you're just an Englishman in England. Yeah. Exactly. Okay. All right. So yeah, again, let's interesting. Okay. All right. So look, guys, looks like I was going to give this computer a last go today. So it seems I'm having some issues. So I'll be swapping out. I'll be swapping out computers for our next. And if I cut off, I apologize in advance. For some reason, I'm having some issues with this laptop. So, anyways, Yeah, what happened to the pound? Well, again, any kind of news uh, i that that is impactful to the financial system there in the UK is going to have people fleeing from the pound and buying dollars, right? So that's really what's going on there. So in any event, let's recap. Not a lot to talk about really that we didn't talk about. Last time I was with you in terms of, if you just pull up your Nasdaq and here at TTS, uh, we are situated with a volatility play as I talked about. Yep. Yeah, that you'll have plenty of opportunity. Remember English in Texas. I don't know what's your name. I don't want. What is your actual name? So I'll just call you by your name. Right. Did you short against the 114? Remember, Keith? Okay, Keith. There we go. Keith, remember I mentioned the 1.114 level that's clearly seen on the charts. That's really where the shorts in the pound should be coming in, right? I told you, I think I mentioned that last. Look at your chart. Are you in front of your computer? So everybody should be looking at your charts while I'm talking to you, right? So if you look at your charts and you pull up like an 8-hour chart, you can see clearly right around 114. We broke down. Remember that one last kind of crescendo in the British pound where we made the new low around 105, and then we had this big rally. So that uh, well, go back and look at the recordings. I don't know. I do these twice a week, Keith. I'm not sure when I. Anyways, in any event, we have an actual accumulation or a buy zone or a demand zone, whatever you want to call it, in the British pound. If you're pulling up your 8-hour chart right now, around 1087, 1.087. Right. Look it up. There's a. I mean, it's pretty wide, but that actually could be a aggressive buying opportunity in the British pound. Right. I don't know if you see that. Pull up your chart of the. I'm only looking at futures. I don't do FX. So if you look at your futures chart of the British pound, that could be a situation where maybe it holds. If it breaks that, then we're probably going to retest the lows on that as well. Yep. Okay. All right. So not really anything. Let's just on the S&P. Bottom line is we keep holding around 3,600. The next level, as I mentioned, I'll just recap real quick on the averages. If we have a hotter than expected CPI number, the next level I have that would even be that I would even consider a buy on the S&P comes in about there comes in all the way down to around 33.75. Okay. So now there is a little bitty level around 35.50 that I've been talking about, and with the VIX down at 40 or up at 40, who knows where the market is. I'm actually more interested in looking at where the VIX goes at this juncture because of the volatility and the fear coming into the market, right? So I would be more interested to see, even if we don't have a level, if we have the VIX, maybe we have a big washout sell-off coming up after the CPI, and then the VIX jumps around 40, and then we have an intraday reversal. That would be the first signal of capitulation. Which, okay. So that's kind of what I'm looking at. In the dollar, not really. The dollar, as I mentioned on Friday, we, not surprising, we had a big jump off the 110 accumulation. Again, very similar. If we can, if the market does that scenario where it sells off hard, then you're going to see the dollar break probably deeper into that above that 114.72, and that would again pressure all the currencies and the metals and everything else. So that really doesn't change a whole lot since we were together. Again, we just kind of continue to meander higher and very similar. And it's all going to be tied to the bond market. Let's finish up with let's talk about the bond market, because obviously that's what's driving everything right now. And we did have, the 10-year holding. I think I mentioned this level last time, that 110.25, 110.18 level, right? Okay. If that breaks, so look at the 10-year chart here. Look at your 10-year chart. 110.25, 110.18. If that breaks here, this will all culminate in the same thing, right? Hi, Ryan. How you doing? Yeah, it's the same level, Ryan. Exactly. Yep. So if again, we have a hot inflation number on Thursday, that should break the bond, the 10-year below against the stock market, right? Particularly the NASDAQ. You will see they are literally trading in lockstep, right? Try that. Pull it up right now. Pull up the chart of the NASDAQ and pull up the chart of the 10-year. You can see that they are literally trading in lockstep. And so, but the question becomes, if they're trading in lockstep, who's leading what? And I would tell you that the interest rate market, the bond market, is the dog wagging the tail, so to speak, right? So bond market is leading stocks right now. And so if you want to get like a little bit of a kind of a leading indicator, if you will, watch the bond market. Okay. And so for that reason, it's very important that we hold on to the 110.25. And for all intents and purposes, if you break that, then you're probably going to get, again, the next leg down on the stock market. Okay. So 110.25, look at it. We have already bounced twice off that. And we did attempt a nice rally, in fact, this morning. And then when that Bank of England news came out, you can see just like stocks, it just fell off again. So it's going to be interesting to see. But all in all, just lots of chop all across really all the markets, really. So they're kind of, tracking each other, bonds, stocks, and the dollar all kind of tracking each other more or less. You can see also the dollar was falling off this morning and then rallied as that news came out. And so that's really what's going on there. Now, let's move into the metals market. I've been talking to you guys about silver and gold. In fact, there's a nice level in gold that I'm liking on the short side. There's actually, on the buy side, I'm really not interested in gold until we get down to this near the 1600 level. So I'm not going to be looking to anything in gold. I think I mentioned that on Friday. And it looked like we were heading down there, and then all of a sudden gold had this nice rally up to about the 1740 level, which I talked about, and now it's in no man's land, so to speak. Gold is kind of in no man's land. The reason I say that is if you think about the low at 1623 and the recent high at 1740, and we basically closed at 1673. That's why I mean in no man's land. And as you know, if you remember from my teaching, anything in the middle part of the move is less likely to work in terms of, yep. Let's see, Ryan. 30 years should get a good bounce. Let's see the 30-year. Let's see. 120. Yeah, that's way down there, Ryan. That's still. We can't even. We're at one on the 30-year. We're at 124. uh, yeah, you're looking way. You're looking. Yeah, I see where you're looking. Yep. Yeah, that would be. Yeah, that's still a little bit of ways. By the way, reminds me, if you guys want to join me for 5 days free, click the link below if you want to sign up for the newsletter. And I also have a class tomorrow, by the way. I just want to, if you guys want to join me for the class tomorrow, it's going to be, I'm sorry, not tomorrow, Thursday at 11 Pacific, talking about timely, again, some hedging techniques that I use with options against your portfolio, or just generally taking advantage of the volatility and hedging some of your long-term stuff as well. Okay, so that's coming up on Thursday, the 13th. So if you want to sign up for that, also click the link below. Okay, all right. So again, gold, silver. Let's move on to, since we're on the metals. And by the way, still tied to the dollar. So the big drop in gold, there was an instance where, we thought, like, silver had that massive rally, gold had that rally, and now pretty much giving it all back. On silver, you can see that move that began right at $19 an ounce. As you can look at your charts, you can clearly see that, we had that monster move in silver. Now we've given it all back. And I do believe now we probably revisit 17 and a half on this. So I'm not really interested in silver at the moment. In fact, there's actually some shorting situation right around 20 and a half or so on silver. But anything, I'm not really that interested in anything on silver until we drop back down and below the 1750. Whether we get there, it's going to be obviously it's still remains to be seen. Oil. Let's move into oil. So I did mention, we're kind of light right now on a lot of the positions because of the way the markets have been trading at TTS. We do have a volatility play on the SPY, as we expect a huge breakout, a huge move in the SPY that would ensue after the CPI. And again, it's a market neutral play, because again, we could have either way. We could have a massive rally if we have a benign number and so forth. But I also have, I am looking to get back into XLE. So I did mention in the newsletter this weekend that you had to be careful with XLE if you weren't in it, that it was a pretty crowded trade. And you can see oil had that massive rally off that 76.44 accumulation, and it's coming, it's coming in pretty good. Hit 94. It's come in pretty good. And I am going to look to get back into oil. There's a gap below in near the 80 level. And then in regards to XLE, which we've done really well with on the option side, I am looking to buy a pullback in XLE. If you guys are interested in something like that, which has been a really good performer. XLE is the ETF that tracks all the big oil stocks, and more or less, I'm using it as a proxy for oil. I'm looking at it back in the low 70s, 72 to be exact, 72.50-ish. Let's see, Ryan. Didn't seem that far away since we went down from 134. Are you still back? Are you still on bonds, Ryan? Yeah, I mean, anything can happen. I mean, there's just, yeah, but one of the things you got to keep in mind, Ryan, is, the bond market is getting pretty extended right now. Yep. Now, again, doesn't mean it can't go down a lot, but I think we're getting to a very big inflection point in the bonds because if you look at the 10-year and the 2-year, the 2 years approaching 4.5, and that's really where the terminal rate is for the Fed, right? 4.5, 4.75. Look at the Fed funds. So I think we're getting really close to the end of the tightening cycle. Probably going to end at the end of this year, and especially if we have some dislocation with what's going on with some of the bond markets and so forth. In particular, in Europe and England and so forth. So that could, if there's anything that would cause the Fed to, maybe take a step back, as if we had some dislocation in the currency markets or the bond market. Okay. Yeah. So I think oil probably pulls back hard here as well, especially again if we go into some more demand destruction. Nat gas, nat gas has been kind of dormant for the last 2 weeks, basically trading between 650 and 7, more or less. And I do expect an explosive move in nat gas if something, and again, it looks like things are heating up in Europe again with Ukraine and Russia, as you know. So that I think that's going to be the next next catalyst for the nat gas, and these type of patterns usually are going to resolve in a big exactly, Ryan. That's the big one. Bottom line, right? Bottom line, Ryan, is CPI. That's really going to be the big catalyst this week. So keep an eye on that gas, because I think it can move very, very sharply on any news coming out of out of Europe, especially with winter coming and so forth. I mean, they've done a good job of stockpiling, but anything kind of changes that dynamic. I think nat gas is poised for a huge move. But in the meantime, just kind of range trading and very volatile. So, okay. Lastly, I'm going to finish up here with, tomorrow, if you guys trade grains, I love to trade the grain markets. We have a big grain report tomorrow, which are going to move the grain markets. Wheat, all the grains have been just all over the place. I mean, we've had a monstrous rally. Yes, over the weekend, gapped up, rallied, came to 950. If you look at your chart clearly, 950, 940, pulled back hard. Tomorrow, and there's a big gap on the charts on the wheat market coming into the announcement tomorrow. So we'll see if that creates an opportunity. I'm going to be looking at the grain market. That's at noon Eastern tomorrow. If you are interested in trading the grain markets, if you haven't traded those, I do encourage you to look at those. There is all of the the corn, wheat, and soybeans do have a 1,000-ounce contract. So if you're not comfortable with the volatility in that market, look at those to mitigate some of the risk. But other than that, yeah. So that's it, everybody. Be careful on Thursday. Know that there's some huge volatility coming. We also have again, tomorrow we have Fed minutes. So that's coming in midday around 2 Eastern. So that could also, have a little bit of impact on the market. So we're still in for a lot of volatility, lots of range trading, very tricky trading the indexes at the moment. But I think that's going to get resolved Thursday, first thing in the morning. I think we'll finally get this thing either going to continue lower, which, from the chart patterns, clearly looks like that could be the direction, but you never know. As you know, we've had some huge rallies off that CPI back in July and August, remember? Then we had the bad numbers in August and September. So it could go either way, really. So be careful out there. Stay safe. Manage your risk properly. Again, one last, if you want to sign up for the newsletter, want to attend the class, or spend 5 days with us in the morning, and I will definitely go through some charts, give you some levels and so forth. If not, have a great rest of your week. I'll see you all on Friday. We'll have a lot to talk about, I'm sure, on Friday, right? Because all of this will be behind us. And we do have some bank earnings coming out on Friday. I do have JPM set up to go to buy on Friday below $100 a share. They report first thing on Monday. So that's kind of how I'll end it. Okay. All right, everybody. Have a great rest of your week. And I will talk to you all soon. Take care, everybody.